Welcome back to the Financial Navigator. I'm your host, Betsum, and today we're tackling two of the most reported and least understood economic concepts that directly impact your wallet, your savings, and your future. We're talking about inflation and employment data. Have you ever felt like you're earning more, but your money just doesn't stretch as far? That feeling is exactly what we're going to diagnose today. To guide us through this complex terrain, I'm thrilled to welcome Guest Name, a seasoned financial strategist and macroeconomics expert. Welcome, Guest Name.
Thanks for having me, Betsum. It's a pleasure to be here. I think this topic is vital because, as the saying goes, if you don't understand the language of money, you can't be a participant in your own financial life.
That's a powerful point. The document we're basing this on uses a great analogy. Navigating your finances is like piloting a plane through a storm. Inflation and employment data are your altimeter and speedometer. Why should the average person who isn't a trader or a banker care about these specific flight instruments?
That analogy is perfect, Betsum, because if you only react to the news, say when gas prices are already through the roof, you've missed the warning. These figures, released monthly, are leading indicators. They tell us where the economy is going, not where it's been. When the Federal Reserve, or the Fed, makes a decision about interest rates, they're not guessing. They're looking directly at these two gauges. If you can read the gauges too, you can anticipate their actions, and that can save you thousands on things like mortgage rates or help you protect your portfolio. It moves you from being a spectator to a protagonist.
Core discussion. Inflation, the economic fever. Let's start with inflation, which the document calls the economic fever. It suggests that a little warmth is good, but a high fever is destructive. Can you break down what inflation is in simple terms and how we measure it?
Absolutely. Inflation is the silent thief. Technically, it's the generalized increase in prices. But emotionally and practically, it's the force that steals your purchasing power. If inflation is 5%, your $100 today will only buy $95 worth of goods next year. It's theft without a masked man.
The document points to two key ways we measure this, the CPI and the PCE. Can you explain the difference, especially why the Fed prefers the PCE?
Right. The CPI, the Consumer Price Index, is the shopping cart you see on the news. It's a fixed basket of typical goods: milk, rent, gasoline. If the price of that basket goes up, CPI is up. It's what hits the headlines. The PCE, the Personal Consumption Expenditures, is the Fed's favorite because it's more flexible. Think of it this way. If the price of beef skyrockets, consumers might switch to buying chicken. CPI would just record the high beef price. PCE adjusts, reflecting that consumers are spending money differently. It gives a broader, more accurate picture of consumer behavior and underlying inflationary pressure.
That makes sense. And then there's the distinction between headline and core inflation. Why do economists ignore food and gas when calculating core inflation? Isn't that counterintuitive?
It is for your daily life. We all feel food and gas prices immediately. But for a central bank trying to map out a long-term policy, those prices are too noisy. A sudden drought or a hurricane can cause a spike in oil or wheat, but it doesn't mean the entire economy is sick. Core inflation, which excludes food and energy, tells us if the price disease has spread to things like rents, services, and wages. That's the real threat.
Core discussion. Employment, the engine of the machine. If inflation is the temperature, the document calls employment the engine's horsepower. Let's shift to the labor market. Every first Friday of the month, the financial world waits for the NFP report. What are the three things we should focus on in that report?
The NFP report is huge. You need to look at job creation, the NFP number, the sheer volume of new jobs. A number significantly higher than expected, say 300,000 new jobs versus 180,000 forecasted, signals an incredibly robust economy. Unemployment rate, the percentage of people actively looking for work who can't find it. A low rate, under 4%, is often considered full employment. and average hourly earnings, or wages. This is the magnifying glass figure. If wages are rising too quickly, companies pass that cost on to the consumer, and you get the dreaded wage spiral, which feeds inflation.
Ah, the great market paradox. This is where people get totally confused. You'll see a massive NFP number, 350,000 new jobs, and the stock market drops. Why is that strong job report considered bad news?
It's all about the Fed's reaction. The market is constantly trying to guess what the central bank will do next. If the economy is too strong, massive hiring, wages soaring, the Fed gets nervous. They think we're going to see runaway inflation. So to cool down the engine, they raise interest rates. And higher interest rates are toxic for stock valuations and make mortgages and business loans more expensive. So the market crashes because of the fear of a rate hike, not because the job report was bad.
Right. It's the bitter medicine scenario. If the economy is doped, the Fed has to administer a painful dose of high rates to bring inflation back down. Emotional and psychological insights. The Volcker lesson. That leads us to the psychological side of this whole dance, which the document touches on with the Volcker lesson. In the 70s and 80s, the Fed chairman, Paul Volcker, raised rates to 20% to kill inflation, causing a massive recession. Why is that a critical historical lesson for today's central bankers?
It's the lesson of credibility. Volcker knew that letting inflation become ingrained, where people expect prices to rise every year, is far more destructive than a short, sharp recession. He inflicted pain, yes, but he established the Fed's credibility as an inflation fighter. Today, Fed officials like Jerome Powell look at Volcker's ghost every time they make a decision. They know that if they allow inflation to persist, they lose trust and the pain down the road will be exponentially worse. It's a trade-off. Short-term pain for long-term price stability.
Practical application. Actionable tips. Let's bring it home. For our listeners who are not day traders but want to protect their savings and make smarter life decisions, like buying a house, what are the most practical takeaways?
My number one tip is don't trade the news, trade the trend. Don't panic sell your retirement fund because 1 month's inflation number was high. Look at the 3 to 6 month trend in the core PCE and the wage growth figures. Is the fever breaking? 2 practical applications. For home buyers, if the data trend suggests inflation is persistent, interest rates will continue to climb. If you plan to buy, locking in a fixed mortgage rate now might be vital before they rise further. For savers, in times of high inflation, the document notes that cash is trash. If you keep all your money in a zero-interest savings account, the silent thief is robbing you. Look at diversified real assets like commodities, real estate, or inflation-protected bonds that tend to perform better.
That's fantastic advice. And finally, what about the famous Fed pivot? Why is identifying that moment when the Fed stops raising rates and starts lowering them the holy grail for investors?
Because that pivot signals 2 things. First, the Fed is confident they've won the inflation battle, and second, it means cheaper money is coming. Cheap money fuels the economy, it makes borrowing easier, it increases corporate profits, and it typically sparks a significant rally in stock and bond prices. Getting ahead of that pivot based on what you see in the jobs and inflation data is the moment you can capture maximum returns.
Conclusion. We've covered a lot today. We defined inflation as the silent thief, employment as the economic engine, and explored the macabre dance between them and the Fed's interest rates. The key lesson here is that understanding these numbers is about managing probabilities, not predicting the future. Thank you, Guest Name, for removing the blindfold for us. It's truly empowering to know what the economic thermometer is telling us.
My pleasure, Betsam. The goal is to remain calm when everyone else is panicking and to spot the opportunities others miss.
Absolutely. To our listeners, we hope this deep dive helps you feel more like a pilot and less like a passenger in your financial life. We'll be back next week with more tools for your financial navigation. Until then, keep analyzing and keep charting your course.